What's going on, everybody? It's Blandon here from mortgagehq. Is it a good time to buy a second property? Well, if you ask majority of the market, they are going to tell you no. But if you actually took the time to find the experienced investors, you're going to find that they are going to say this is the best time to buy. I'm talking about the people that have been through the property cycles, that have experienced the busts and the booms. A lot of these property investors are probably stuck in their position as well, because lending positions have changed significantly, and it's now a lot harder to borrow for property investing. But if you're in a position where you have built up a lot of equity and you've bought that house a few years back, you haven't explored property investments, this might be a very good time for you to learn more about that. If you ask the experienced investors, they know that uncertainty brings prices down, and currently we've got the war, the inflation, the rising interest rates. These all have a significant impact on property prices, and it's a negative one. You're going to see property price sort of stagger in the near future, but we just never know when it's going to start back up again. So in this video, I'm going to show you exactly how you can calculate what your accessible equity and your max borrowing power is on the next property, how to best structure a property investment loan, and thirdly, just a simple calculation on how you can work out your repayments so that you can find out what sort of rent you should aim for on the next property. And if you find anything that's interesting and you learn something, definitely support us by smashing the like button for the YouTube algorithm. Really appreciate it. So the max LVR, which is the loan to value ratio, currently is at 60%. Now this is at the main banks. If you went to non-bank lenders, you'll be able to borrow up to 80%. And also if you're buying new builds, you can go up to 80%. But for this illustration, we're going to just use the 60% to work out how much borrowing power you can get from the bank. All right, so you have the value of your home. You want to find out what that is. Let's say if it's $1 million, then this is how you can work out how much accessible equity or the max purchase price you have on the next property. So you take the million and then times it by 0.8, right? You can take your current property and you can multiply that by 0.8. So in this illustration, you're going to get $800,000. So with this $800,000, you want to bring it down here, and this is what we call your max lending, right? This is the maximum amount that the bank would lend you based on your property. You have to keep some of that skin in the game, and you want to take off your existing mortgage. Now let's say your existing mortgage is $400K, so that leaves us an accessible equity of $400,000. And how this is worked out is basically this is the max amount you can get from your bank, and then you got to take off your existing mortgage that you already have, then the bank will lend you a further $400,000. Now you bring this down to here, $400,000, and you want to divide it by 0.4, and 0.4 is your LVR, which is 40% deposit. So if you divide it by 0.4, you get the max purchase price of $1 million, and this is how much you can spend on your second property. Now it's very important to keep in mind that servicing is a major factor with the banks. This is looking at how much you can actually borrow. Now presuming you have really high income, then you can probably get that $1 million quite easily, but most families starting out to buy their properties is quite hard. So if they were only able to buy a 3-beddy, right, they will only be able to maybe get around $700K. Let's say if they were on a $200K household income and 2 kids, and they only have like $500,000-$600,000 mortgage. So they can only get around $700,000 mortgage, and this is what we call a 4.5% gross yield. If you want to learn more about what gross yield is, you can just search our channel and there will be some video on how that works. So if you just buy a standard 3-bedroom, not that exciting, but if you were to go down the route where a lot of property investors or experienced investors will do as well, is to buy multi-units. This is buying properties with multiple houses on it, 3 or 4 units on it, and you might get a 10% yield, so you can rent out each of them for sort of like $340, $350, $600, depending on which region you're in. And in the same situation, because now you're getting 10% yield, the bank is actually going to allow you to borrow around 1.7 mil for the same situation. So it would significantly increase your borrowing power if you're buying properties with a high percentage in rental income. Now the second part that we got to explore is how you want to structure your mortgage. Now there are 2 main ways you can sort of structure your mortgage. One is interest only, and the other is principal and interest. As you can see, if it's interest only, you basically don't pay back your loan, and it's $1,000 a week. And if you take out the principal and interest loan, it's going to cost you $1,375. 1.5, which very likely, if you're not getting a high yielding property, it's going to be negative cash flow. So to control your cash flow, we always recommend that you take interest only. Now, just because you're only paying interest, it doesn't mean that you don't want to pay off your mortgage or you just leave it unpaid. You can actually choose to repay 5% lump sum every year for most banks for no extra cost, or when the interest comes off fixed, you will be able to just pay a lump sum and pay down that mortgage. So interest only is a really good way to control your cash flow. It's going to minimize what you need to pay to the bank and going to maximize your flexibility. So we always recommend interest only. And so if we went down and look at how your mortgage will look like, is you would put majority of your mortgage on interest only, fix, and sometimes you might even fix it for longer term, especially in this current market. For your investments, you might fix it for 2-3 years to give you a bit more certainty. And then you want to have a portion of this mortgage on a revolving credit facility. Now, it's important to note that now that mortgages are not tax deductible on an existing property, there are 3 major ways that clients have been using to get tax deductibility on these mortgages. So one is simply buying a new build. Now, new build does give you that tax deductibility, but you're not going to be able to buy as high yielding property. So you might end up in the same position in terms of cash flow if you were to buy in the regions of multi-unit. The second way of actually getting this interest tax deductible is to go social housing route. This is getting a contract with Housing New Zealand, and they will allow you then to have this interest deductible. This will then allow you to claim this interest and its expense. The long story short of what that actually allows you to do is give you a bit of tax money. You might save around 25 to 30% of whatever you're paying in interest. And the third most common way is our business owners, they basically restructure their business. If they have a business that have value, which means they can sell it on the market, they could put a valuation on it, they could restructure their position and have this debt in the trust to make it tax deductible. So if you're a business owner that have a established business, this might be a really good option for you to explore. It's going to allow you to minimize your tax obligations as well. So now for the simple formula on how you can work out how much your repayments are going to be, so you can aim for the rental income you need. So if the interest rate is at 5.2%, you take your mortgage, say $1 million, you would multiply that by 0.052. This is basically taking your interest rate and put the decimal point over to 2. So now this is going to give you 52,000 per year, and you want to divide it by your weeks of 52. This is going to give you a result of $1,000 per week. This is how you can quickly work out how much your repayments are going to be, and this is going to allow you to sort of work out your budget, because you also have your rates and your insurance on top of this, and you might even have a property manager, especially if you're going to buy a house in the regions. And with that said, it gives you a really good indication on how much return you should be aiming for on the next property, because if interest is going to cost you 5.2% and your rates and insurance is going to cost you around 1.5 to 2%, then quite easily you need to aim for properties with 7.5% or more, and that's presuming that you have interest deductibility on that loan. And if you don't have interest deductibility, you'll need to aim for even higher. This is a more complicated calculation, but if you talk to a mortgage advisor, this is exactly what they can sort of go over with you to give you a better understanding. With that said, hopefully you got a better understanding of how you can buy a second property and some of the property financing behind it, how you can structure it, how you're going to pay for it, how you're going to get the money to buy it. So if you want to learn more, subscribe to our channel. Definitely a ton of videos around property investing and finances. And if you want to really deep dive into some of the case studies, I'd recommend checking out our website, mhq.co.nz. Under masterclass, there are stage 1, stage 2, and stage 3 is going to be the best way for you to get started in properties. And until next time, I'll see you guys in the next video.
My favorite thing about the workshop is how simple it is. So language is really easy to understand, so anyone like with no property knowledge can understand what's going on.